maybe looking at buying their first home. And of course, we'll be talking about buying multiple properties this year, but also a few things involving if you're self-employed, what to do, making sure that you're set up for success in 2026. So welcome to the webinar tonight. Looking forward to going through quite a few things with you today. So talking about first-time buyers, anybody that has a pre-sale contract. And so if you have an offer in on something and you're not really sure, when it's going to complete, et cetera, if you do have a pre-sale contract, it's important for you to be thinking about how to be getting set up for that, even if it doesn't complete until next year. Some things that you may need to be thinking about in order to be making sure that you're set up for success on that. Anybody wanting to buy, whether you're buying your first home, buying a rental property, buying a cabin, et cetera. Getting sure that you're prepared and ready to be able to complete. And if you have a renewal that's up in 2026 or early 2027, the reason that I say early 2027 is I'm finding that in many cases, it may make sense to break that mortgage a little early, even if it doesn't renew until 2027, just because the penalty versus the savings and some of the calculations may be in your favor. And we can always do that on more of a one-on-one basis because every situation is unique depending on your penalty and depending on how large the mortgage is, et cetera. But if your renewal is coming up in 2026 or in early 2027, it's good to get prepared in advance. The really big thing here is that if you fail to plan, then you plan to fail. I see this a lot of times as a mortgage broker where we're helping people set up their finances and they're coming to us really late in the game. And there's just not enough time for us to rejig things and prepare them, where if we had more time, then we could set them up for success. And so it's really important that with a new year, get organized, get prepared, get set up, and just have a clear idea of where you're going and how you're going to get there. Now, something that I'm going to be referencing throughout this is we do have a game plan worksheet, and we're happy to send that over to anybody who would like a copy. And so after, at any time, I'll just put in the email into the chat here. If you want a copy of this afterwards, everybody will be sent a copy of this recording afterwards. You can just follow through and fill this in afterwards. But note that this is a document that we can share with you, and then you can kind of work through that. So it is something that's relatively basic and straightforward. But I do want to highlight the very first step of this process, which is if you're wanting to do something this year and buy something this year, then we need to hone in on where is your down payment coming from. And so regardless of whether you're buying your first home or buying an investment property, you need to figure out where your capital is coming from, and usually getting your access to capital figured out early on is a really important key to this. So there's different methods that you can come up with. Underneath the what's called own resources category, we have cash savings, we have RSPs, FHSAs, and gift is not really own resources, but I kind of threw it into this category because it's not borrowed and not a loan. But a gift from family is something that of course is very common and frequent. Actually, we just had somebody in our office that Brian, one of my account managers here, was mentioning that one of our clients is getting a $500,000 gift to buy his first home. So very, very nice. Brian and I looked at each other like, wow, that would be nice to get a $500,000 gift. But it's actually not that uncommon, which is interesting. One of the strategies actually we talked while I mentioned the gift is we've actually had a couple of webinars about reverse mortgages. So a lot of people that either parents or grandparents who have equity stuck in their home and can't get access to it and don't have the ability to make payments on borrowed money. One of the things we're finding is people are getting reverse mortgages in order to do early inheritances so that the kids or grandkids can start to get their first place. So lots of different ways of passing that generational wealth down the chain, so to speak. One of the very common ones, and this is very common, especially for real estate investors, is using a HELOC, a home equity line of credit, for the down payment. This is the most common reason for that, and I will get into, there's a separate slide that talks all about HELOCs and how to use it effectively and wisely. And then, of course, just a standard refinance. You can refinance up to 80% of the property value of any properties that you own. And so if you're trying to figure out how much capital you have access to, if the property is worth $1 million, that means you can get in total $800,000 worth of debt against that property, assuming that you qualify. So if you already have a $500,000 mortgage, that means that you could get 800 in total minus the 500 you owe. That's $300,000 in extra cash that you can have access to use towards down payment on another property. And if you can put 20% down, then you can effectively turn $300,000 into about $1.5 million worth of real estate acquisition. So even just a small amount of equity can spin off and allow you to buy a lot more real estate down the road. So getting into the down payment and the minimums and whatnot, one of the often misconceptions here is that you have to be a first-time buyer to put 5% down, and that is not the case. You can put 5% down on a primary residence or even what's called a second home. So property you're buying for yourself or immediate family to use, and there's no expected rental income coming from it. So you can buy that with 5% down, and you do not need to be a first-time buyer. You just have to be buying your own primary residence or second home. There are some restrictions on how many times you can do this. So I think the maximum now is 3, although I think some of the insurers actually cut you off at 2. So just note that that you couldn't do this over and over and over again. And frankly, it gets really hard to qualify if you're always putting 5% down. But you can actually do 5% down on a primary residence, and you can go up to the down payment is 5% of the first 500,000, and it's 10% on the remainder. Up to now that the insured limit has gone up to $1.5 million as of yesterday. So there's a quick question: can I have a second home, a condo, in addition to my primary single-family home? So you could. It's just that you would have to be able to qualify based on the income, on your personal income, and no income from the property. So if a family member is going to live in the property, etc., then you can buy a second home for them to use and for them to live in. Or if you travel a lot and you live here and you're traveling to this area quite a bit, you could also have a second home in that location. You generally just have to have a good reason for it. The lenders are mindful of the fact that they don't want people buying what's effectively going to be a rental property with only 5% down. So Ezekiel, your next question: what's the minimum for a rental? 20% down is the minimum for an investment property. So you have to have 20% down. That's the minimum. And there are a couple of ways that you can come up with some cash if you're buying your first home. So there's the RSP plan, and the number keeps getting bumped up. And as of now, it's actually $60,000 per person that allow you to take 60 grand out of the RSPs tax free. And I'll get into a little bit more of the details on the RSPs in a moment. The FHSA can get up to $40,000 each as well. So there's a fair bit of money that can be saved underneath that program too. And you can also borrow your down payment, which, oddly enough, you can actually still borrow your down payment, your 5% down, from a line of credit or even a credit card, which is kind of crazy to me. The insurers will allow it, and some lenders allow this program, some lenders do not. There's a very high payment associated with borrowing the down payment, and so you'd have to have a really high income, and your qualifications have to be quite good. It's very rare that we see people doing borrowed down payment for their first home, especially with less than 20% down. Where I do see the borrowed down payment come up a little bit more is often for doctors, dentists, etc., professionals who have a student line of credit for a couple $100,000 that they used while they're in school. They started to pay it down, and now they're wanting to buy their first home, but they have a very high income. We do see that doctors and dentists, etc., are more likely to use those really large student lines of credit as a means of being able to use for their down payment. And then there's a question here: are any lenders using short-term rental income revenue for income? Very difficult. So not if that's the property that you're buying, but if it's a property that you own, some lenders will allow us to use it if it's reported on the tax returns. So the biggest key with short-term rentals is if the lender thinks that the purchase is a short-term rental, very difficult to get financing on it. And if the existing property is a short-term rental, but you haven't filed taxes yet for that year, then it's very hard to use income. But once you have filed the taxes and it's showing up on your T1 generals, your personal tax returns, then lenders will allow you to use short-term rental income to help qualify, as long as it's just not the property that they're financing. So a couple things to break down here, because the FHSA, the First-Time Homebuyer Savings Account, is a little bit different than RSPs, but you can see there's a lot of similarities. So they both reduce taxable income. And there's caps. And so the FHSA only allows you to put $8,000 in it per year, and then it's capped at 40,000. It's possible that over time they may increase it, just like they increased the cap for the RSPs, which has gone all the way up to $60,000. Recently, about a year and a half ago, it was only a $35,000 limit. So they've almost doubled it since last time. Both of them have a tax-free withdrawal type of program if you're buying your first home. And also, which is interesting, the FHSA, if you never use it, you can transfer the money into an RSP. So at least that way you don't get the money stuck there and you say, okay, well, now what do I do with it? I'm not going to end up buying my first home. So you can actually transfer it into your RSP if you're not using. Now with the FHSA, after you buy your first home, you do not need to recontribute back into it. The RSP is a little bit different. You now have to repay your money back into the RSPs over 15 years over the first-time homebuyer program. So it is a way of generating some cash, but then you have to recontribute back into the RSPs over an extended period of time. Now, I want to show you guys something really cool. And I know that a lot of you here are not first-time homebuyers, but you may know some first-time homebuyers. And the timing is really important for this kind of stuff too, because you need to do this right around tax season to be able to take advantage of it. So let's say that you had 60 grand in either cash or TFSA, something that's not registered right now. So if you had 60 grand and you were thinking that, hey, I want to, start to save up for my first home and I want to buy something this year, you took the cash and you put it into an RSP or the FHSA, and of course you have to make sure that you have the allowable contribution limit into your RSPs, which you can check on your notice of assessment that you get back from the CRA when you file your taxes. But if you look through this, if you have the available room and you can put the money into RSP or the FHSA, what ends up happening now is you've reduced your taxable income by $60,000. If you reduce your taxable income while you're in a tax bracket of, let's say, about 30%, what happens is you get that money back when you file your taxes. So if you're getting 30% back on your $60,000, well, now you're getting 18 grand in your tax return. So now what's happening is you still have the 60 grand in the RSP or FHSA, but you have an extra 18 grand that you got back in your tax return from the government. So now you actually have $78,000. So you've generated 18 grand out of thin air. So I really like this, and the timing is good. So if you know anybody who's wanting to buy their first home in the next little while here, and they have some money that's not in RSPs and or FHSA, then you might want to tell them about this trick, and of course you can connect them with Brian or I in the office, and we'll be able to share more information about how exactly they can do this. Now, if you're a first-time homebuyer, you're not really convinced that buying a property makes a lot of sense, we do have a rent versus own analysis. You can download it from the website or send us a note, and we can email it over to you as well. We can customize it for your situation as well. So there are some circumstances where if you're renting a really nice home in Point Grey in a $5 million home and you're paying $4 grand a month in rent, well, it probably doesn't make sense to own that property. And so the analysis is probably going to be a bit off because your rent versus the cost of ownership is quite different. But for most people, to buy the condo that they're already living in or something along those lines, you have to make sure that you're comparing apples to apples. You can't say, oh, I'm renting a 30-year-old house or a 30-year-old condo and I want to buy a brand new, bigger, nicer condo. Well, that's not the same units. You have to compare apples to apples. But when you run the analysis, and I've done this recently because I'm speaking at a event for Anthem Properties on the weekend, and we went through a couple of examples of a rent versus own analysis. And we looked at a condo for about $550,000 on a rent versus own basis. And it showed that if they were investing the difference, because ownership is usually a bit more expensive per month on the payments, but if you took your down payment and invested it, and you took the monthly contribution and invested it at a rate of about 4%, then your overall net worth would be higher by about $210,000 after 10 years if you owned property instead of just investing in the markets. Now, some people argue, well, 4% is a pretty low rate of return. It kind of depends on, the appetite of the individual and how risk adverse they are. But you can bump that number up. And what I like to look at is the break-even point. I looked at it, and the break-even point to rent instead of own is you'd have to be making more than 15.25% in your investments consistently every year for you to have a higher rate of return by renting and putting that down payment you have into an account and that's earning 15.25% per year, and investing that few $100s a month extra that you'd be saving by renting, not owning. So those are pretty steep numbers, and it's mostly because of the power of leverage of home ownership, and also that you're paying down the mortgage. And that in that example where they were looking at, the payments in total to own versus rent were about $300 more per month. However, the principal pay down was over $700 a month to start, and by year 10, it was about $1,100 a month. So, it basically creates a forced savings account for you if you're a first-time buyer. Now, if you already own a home, then you should be looking at using your home equity. And of course, this comes down to the risk tolerance that you have, if the type of investment return and whatnot is appropriate for you. But the reality is that if your home is totally paid off, or that's the plan, other than appreciation, there isn't really any type of gain that could be had. So how do we do this and how do we structure it? We're typically getting a home equity line of credit, and this is usually the advised product for most people that are wanting to invest in either real estate and stocks or whatever. But a readvanceable mortgage is a way of being able to minimize taxes and to invest at the same time. So here's the dilemma. A lot of the time people are say, well, should I save up my money to invest or should I pay down my mortgage? And with a home equity line of credit product that's readvanceable, the answer is pay down the mortgage, which then opens up the line of credit, and then you can use that to invest. So it's actually to do both. So let me give you an example. Let's say that you owned a home worth $500,000 and you had a $225,000 mortgage on it. You could get up to 80% of the property value. So in that case, you can get a line of credit for $175,000 because you can refinance up to 80% of the property value. So 225 plus 175, that's 400,000. So that's 80% of a $500,000 value. Now, what happens is as you pay down the mortgage on the non-tax deductible personal portion, you can reborrow that money because your line of credit limit will increase as you pay down the mortgage. And then you can borrow that money out on the line of credit, and then you can use that to invest. And whenever you borrow money to invest with the intention of earning an income, the borrowed funds are tax deductible. Now, I always have to preface this and say you have to talk to an accountant, make sure that you understand all the pros and cons. I'm not an accountant. But this is the key function, is that if you're borrowing money to invest, the interest portion of the payments is tax deductible. So this type of product, if you don't already have it, if you have a renewal coming up in a property, you don't currently have this type of product on a property, this is often what investors like to do, because then you get the line of credit, so you don't have to borrow and don't have to pay interest on the money until you actually need it. So it's just sitting there, it's available to you, and then in the future, if and when an opportunity arises for you to then dip into it and grab access to the capital, then you can do that. And sometimes as an investor, and I'm seeing this in the market right now, I just had a client write an offer on a condo downtown. The seller is wanting to sell very, very quickly, and they're writing an offer with a 2.5-week completion, very, very tight. If you had a line of credit big enough to just buy the property with cash, you could write an offer with a 5-day closing. And I almost guarantee you that somebody that's really, really desperate to sell would offer you a better price than somebody else. And so a line of credit gives you flexibility and gives you an advantage over others because you can act much quicker. You wouldn't have to get a mortgage necessarily because you could just write the check and use the line of credit. So a key important thing to understand when you're looking at the line of credit is the difference between good debt and bad debt. You want to minimize the bad debt. So that's a depreciating asset, consumer goods, things like that. And you want to be looking at good debt. So buying property, buying real estate, stocks, things that are going to go up in value. It's okay if you're borrowing money, but against things that are going to rise in value as opposed to things that are going to go down in value. And then, of course, making sure that if you can, structure it so that it's tax deductible, making sure that the mortgage and everything is set up in the right way. For anybody that wants more information on that, there is the Smith maneuver. That's the popularized term that's out there. I think I might be out of books, but if you'd like a copy, we can always see if we have any more sitting in the office here, and can pop one in the mail. Or there's more information that we can send to you about that. Both Brian and I have gone through the courses and everything on the Smith maneuver, so we're very familiar with all the details, and I've helped a lot of people set that up. So we've gone through the down payment and whatnot, and so let's go into the next step, which is on the income side. So on the income side, there's some calculations here, and it of course depends on a number of factors, but generally speaking, you qualify for about 4 to 5 times your income. That's the math on it. And so every $100,000 you want to borrow requires about $20,000 to $25,000 of income. So you can look at it either way. 20 to 25,000 of income equals 100 grand on a mortgage, or you can just say it's 4 times or 5 times your income. But this is the important thing, is to look at, okay, well, what is your income and how much do you qualify for based off of that income? So this is the quick math version. If you own a lot of rental properties, if you have other debts, if you have other things going on, then this math gets a little bit more complicated. But if you're just trying to do quick math on, okay, how much do I think I can qualify for? Then this is the quick math, and this gives you an idea of the range that you need to be in. Now, this is where we have to get a little bit more dialed in on a couple of things. So especially for those of you that are self-employed, the income is based off of a 2-year average. And in fact, even if you're not self-employed, but if you have any type of role where the income is not guaranteed, because the lenders always want to use either guaranteed income or what you've averaged for the last 2 years. So if there's any fluctuations with that income, lots of bonuses, et cetera, they want to see a 2-year history. Now, a couple tricks or tips, I should say. It's not really a trick, but if 2025 was not a good year and you're self-employed, most lenders are looking at the 2023 and 2024 tax returns for the next few months. But eventually they're going to say, hey, we need those 2025s. We need them filed. We need to see what that number is. And so you can kind of get away with it until the taxes are due. And if you're self-employed, you can get away with it until probably around June or so before they say, hey, we really need to see what the 2025 taxes look like. Some lenders will ask for a little bit more information. Some of them will ask, hey, did you file the T-slip for the T4 income, like the employment income or dividend income? So sometimes this can come up a little bit and they can say, hey, we need to see that. Now, if 2025 is a good year, i.e. is raising your average, then get those taxes filed as soon as possible. We actually work with a lot of clients where we reverse engineer how much income is needed in order to qualify for what they want. And then we tell them, okay, if you want to buy this, or maybe you have a pre-sale that's closing at some point in 2026, then we work with clients, and I think even many of you that are on this call, we say, okay, in order for you to qualify for that, your income needs to be this much. So we need to make sure that you build it up and we work with you and your accountant and make sure that there's enough income to be able to do that. And here's the tough part, is you're trying to balance, well, I want to have as many tax write-offs as possible. I want the accountant's trying to do their job and minimize that income. And you're trying to say, okay, well, and the mortgage broker's trying to say, well, let's get up the qualifications. But they work in the opposite direction. The more write-offs you have, the lower the income, the lower the qualifications are. And so sometimes you do have to get a little bit more creative if there's not sufficient income. So a couple of things that we'll look at doing here. If you're incorporated, they can use corporate net income. So if you earn an income inside of a corporation, whatever is earned and retained in the company, you can use a 2-year average. These programs are not available with just 20% down. For these programs, it's 20% down minimum. And they use about 50% of the income that is earned and retained in the corporation. So you don't get the full benefit of all of the income as if you paid yourself, but you do get some of it. And so that's good. One key is that you have to own the company 100%. And they do allow this for residences and even rental properties. So this can be good for those of you that are incorporated and not paying yourselves enough income. There's another program called stated income. So what we do is we actually reverse the normal order of getting a mortgage. So instead of saying, my income is 125,000, therefore I qualify for 625,000. Instead, we reverse it and say, well, what do you want to qualify for? And then how much do we need to state the income is in order to qualify for it? And so we had a client, for instance, that opened up a new restaurant in Vancouver. And the first year was just setting up the restaurant. And he only started opening up the restaurant, I think it was in December of 2020, 2024. And so there's very little income for that year. And then they hadn't quite filed the most recent year yet. And so they had a lot of financial information to show that the company is very profitable. They had some good information on how much income tax was going to be filed for the business. But the income on paper was minimal. We're talking like $40,000 or something like that. In order to qualify for the loan, we needed to state that they earned about $250,000. So I ended up calling the head of the underwriting department for the lender, called the mortgage insurer, and worked with them to figure out how to structure the deal. Because We actually did that with 10% down. So you can actually do this underneath the insured program. And this is a unique program. It's very hard and they're very difficult to sell. And I do find that these are important keys. Because we do business loans, we know how to read financials and how to sell those types of deals and what information to prepare. These types of loans are typically just on the A lender side, so major banks. It's really just for owner occupied and insured mortgages. So this is not available for rental properties. Then you have B lending. And so B lending is similar too. They kind of use a stated income approach, but then they, instead of using tax returns to determine the income, they're going to use bank statements to determine the income. They're going to look at how much money is actually hitting the account every month, look at the expenses and the income based on off of that. Usually you want to see about 6 to 12 months of business bank statements. Often they need 20% down as the minimum, and then sometimes they need 25% down, depending on the situation. Residence or rental is okay when it comes to B lending and alternative lending. So there are different options for that. I do have a question in the chat that I'll answer now because we're kind of diving into this now. So if the company is owned by a holdco and the holdco is owned by a trust and I'm the beneficiary of the trust, does it qualify with must own the company 100%? So complicated. What it comes down to is they need to know which company earned and retained the money. So sometimes the money's bouncing around a whole bunch, then it can be hard to trace this and hard to follow it. We need to see where the money eventually landed and stuck. And so if the money lands and sticks in an entity that you own 100% of, then we can use it. So we would have to go through and check all of the financial statements for all of it because we have to show the initial source of where the income is earned and then keep following the money. So those are more complicated. The answer is maybe in your circumstance, but I have to take a look at the financials. Okay, so we've talked about the income. Now let's talk about the current portfolio and what you've got going on there. And so there's a couple of things to look at. We need to, if you do own current properties, then we need to understand how lenders are treating the rental income to help you qualify. So most lenders take about 50% of the rental income, add it to your income, and then they only want about 44% of your income to be used towards your debts. So here's the thing. If you had $1,000 a month in rent, they're going to take 50% of it, so $500, add that to your income, and they only want to use about 40% of your income. So that's $200 out of the $1,000 that's actually being used to service debts. It's not a lot. Now, some lenders have what's called an offset, and some credit unions in particular will use an 80% offset. This means that 80% of the rental income offsets the expenses, and whatever's left over is a liability or income. So if they're taking 80% of the $1,000, in this case, $800 is being used. It's significantly more, and it makes it much easier for you to qualify when they're using $800 a month for the rent instead of $200. The last method, which I do find on the residential side, is becoming less common, but some lenders use what's called the DCR, debt coverage ratio, and they want to see that overall in the portfolio that the rental income is about 1.1 to 1.2 times the expenses. On the commercial side, which is also how they do it on the commercial side, they usually want to see a ratio of 1.2 or 1.25. So the properties are what's kind of carrying themselves or servicing themselves. Again, less common on the residential side. A few lenders still consider it, but most of the time, that's how commercial lending is being observed. So understanding, what your current portfolio looks like, and understanding, okay, are these properties going to be a net positive or a net negative for me? Then you can start to look at where to buy, what to buy, how many properties you'd like, and what the total cost is. And then you just put this all together. You start to look at, okay, will my income support refinancing my residence or rentals for the down payment? Do you have enough cash to purchase the property? Looking at whether you have enough money to do that. If not, do you need to involve joint venture partners or any other sources of capital? And also, how long do you want to take to build the portfolio? Because, of course, the longer it's going to take to build it, the more cash you can save up and do other things with. So, there is a kind of a basic approach and method to building this and growing that. But the real keys that we're trying to look at here is making sure that you know all of the things that are set up. And if you're buying your first home, there's a lot of little tips and tricks you can do to generate some extra cash for your down payment. If you're a real estate investor and wanting to buy properties or have renewals coming up, then it's important to look at what's the right setup and structure. Making sure that you're setting up, and if you're wanting to buy more properties, then making sure that you're having the lowest payment possible when you restructure those mortgages. So even if it's just coming up for renewal, somebody's re-amortizing your debt over 30 years to lower those payments will help you when you're ready to buy a property again in the future. And that's usually what we advise for anybody that wants to buy another investment property, for instance. So everybody always wants to know what's going on with rates, Kyle. Where are things heading? And it's an interesting time. But the interesting part about this is that the Bank of Canada, they've currently paused. And a lot of people are kind of wondering, well, what does this mean for the future? Where are we heading? This is the current forecast curve. And so this is showing what the economists and what are called the basically people that professionally bet on where the Bank of Canada is going and where the bond market is going. They're predicting that this is going to be the increases. Now, the top orange yellow line there, that's the Bank of Canada expectations. So you can see that actually as early as 12 months, they're expecting maybe one tick up on the Bank of Canada. Now, I do find a lot of Canadian economists are actually expecting this to be flatter for longer, or even potential decreases later in 2026. Whereas worldwide, the economists are predicting some slight increases. So who knows who's going to be correct on that? But long story short, it's showing actually that the Bank of Canada might slowly increase over time, which is not what some people want or expect. Now, the blue line at the bottom, I know that this is something called a 4-year swap. It's complicated, but long story short, that specific instrument is the best way of knowing where 5-year fixed rates are heading, because that's the instrument that the banks use. And so you don't look at the number because they're always basing it off of that plus a premium. Usually that premium is about 1.5%, give or take, over top of that for 5-year fixed rate money. But you can see that in the next 12 months, they're expecting that to go up by about 0.25% and then about 0.2% per year each year for the next 5 years. So long story short, this is saying that we might be at the bottom. Now, the reason that I brought this up earlier in one of the first slides was that if you even have a renewal coming up in, let's say, 2027, we're finding the breakage penalty and the savings over that 12 months or 15 months that you've got left in your mortgage is identical or very close. So why would you consider breaking the mortgage now? It's because even if the rates move up a small amount, so even if they go up 0.25% or 0.5% over the next few months, if you get a rate hold in now and you have a rate guaranteed, and if rates keep climbing, because there has been a couple of hikes since December, like TD Bank's gone up twice, and most banks have gone up at least once in that time period. If rates keep climbing, eventually it's going to make sense to break that mortgage, because all other things being equal, when your renewal would be coming up, if you're renewing at a higher rate than the rate hold that you have now that you could hold for, let's say, 5 years, you're going to save a bunch of money over the term of that mortgage in total, over a 5-year period, instead of just being where you're at for the next year and a half and then renewing at a higher rate. So without diving into too much of the math today, and that's not really the feature of the presentation today, but if you do have a renewal coming up, you might want to run some numbers by us. We can do some calculations and send you over an Excel spreadsheet. Those of you that know me know I love my Excel spreadsheets, but we can run some numbers for you and give you an idea of what that looks like. But long story short, we might have hit the bottom for rates in the short term. I'm still not totally sold because of the impact to the free trade agreement and whatnot, and what that's going to look like. If that gets ripped up and Canada suffers, then we might be dropping interest rates here in Canada. But there is inflationary pressure all around. Japan just had rates jump up through the roof just the other day. That's not good for Canadian bonds either, and may push rates upwards depending on how that all transpires. So, couple key things to summarize. Make sure that you prepare your taxes properly. And I know it's really hard sometimes to know like what exactly you want to buy, but you can work with our team and we can map out, okay, if you wanted to buy this type of property in this price range, then this is how much income you need to have. And so some things you might want to give yourself a bit of a buffer in case you go a little bit higher on the purchase price or whatnot. But if you're self-employed and you're trying to figure out how much to file on your taxes, file them properly. Another very important point, and this comes up way more than it should, frankly, is rental income being claimed on your tax returns. Almost every lender will not use rental income if it's not on your tax returns. So this is a really big issue. A lot of people do not claim it. They think, oh, I'm just going to, take cash and I'm not going to do anything about it. Honestly, in most cases, the tax implications are almost nil in a lot of these situations. And the reason for that is that, yes, you have to claim the income that's coming in, but then you also get to claim all of the expenses, the interest, the property taxes, the strata fees, maintenance, travel, if it's related to your property. All of these other things get to be tax deductions too. So talk to your accountant about that. But it's really important that those of you that are looking at buying something the next little bit, you need to know that if you don't file the income on your tax returns, almost every lender will not use it, and that can be a big deal killer for you right there. If you have a pre-sale, make sure that you can qualify for it. We've had a lot of scenarios and issues. We have a few in the go right now where people are coming to us and saying, hey, I thought it was good and now I'm not good. My bank told me no or whatever, and we're trying to save it. Make sure that if you've got a pre-sale, you need to make sure that you can actually qualify for it, and we can help you map that out and make sure that you're good. We can also get a long-term rate hold for you in case rates climb. And usually the long-term rate hold's at a third bit of a premium. So I still don't think that you'd even have to take that higher rate, because you always get to get the best rate that applies, either the rate hold you have or whatever rates are at closing. But it can still protect you just in case rates rise more than you expect. Another thing, eliminate non-mortgage debts if you're trying to qualify for something. A car loan, for instance, the payment associated with the car loan is typically much more than it would be if it was borrowed on a mortgage. That's because the term or length of that debt is much shorter for a car loan than it is on a home. Any unsecured debts, etc., those all need to be eliminated to help qualify. If you've got a mortgage renewal coming up, make sure you shop it. I do find that lenders are very aggressive on renewals right now, but every once in a while we'll find an opportunity where it can save you money, especially in certain circumstances. So make sure you shoot us an email with the details of your renewal, or if you have any questions or anything like that about your renewal. We have a lot of renewals this year. In fact, 2026 has more renewals in Canada than the history of Canadian renewals. So more people are renewing this year than ever. And so we're very active and very busy with renewals this year. And then create a plan and take action. I mean, it's as simple as that. Just figure out what you want to do and then start to actually take some action. Nothing happens until you actually take action. Feel free to learn more. Of course, we have our next webinar. We haven't decided on the topic yet, but it will be February 11th at 7 p.m. And I'm very excited to announce on February 21st, we're going to have another in-person event. So those of you that have attended some of these events before, get excited. I'm very excited about it. We're going to have 6 different speakers at this event. And so it'll be a wealth summit. We're going to be talking about a number of different topics. So I'll kick off the day talking a little bit about the expectations in the marketplace, what's happening with interest rates, and what people can expect on that. I'll do a bit more of a deep dive than I went into today. Brian on my team, he's going to be talking about residential financing and qualifying for residential property, and talking a little bit more about the Smith maneuver and going to some more specific details of different programs and different things you can do to save money in taxes. And then we have a couple of other speakers. So James Livingstone, they're a multiplex expert in the Greater Vancouver area. And so they're doing a ton of projects here, and they've got some pretty interesting ways that you can be an investor, or if you own a home, you can actually roll that into the investment, and you can effectively partner with them to have them build a 6-plex or 4-plex on your property, which is really cool. Lisa's going to be talking about insurance-related investments. So one of the cool things about insurance is it's a tax-sheltered investment strategy. And so she'll go into some of the new nuances and interesting ways that you can invest via insurance vehicles. Justin Smith has a private equity firm called Hawkeye Wealth, and he'll be talking about making investments into, generally speaking, real estate-backed private equities, including mortgage investment corporations. And then Gary Conrad will also be talking about a specific mortgage investment corporation called CareVest, who do a lot of residential, commercial loans, construction loans, etc., mostly in Greater Vancouver, but around BC to a certain extent. So a lot of different speakers. We're going to have three up back to back to back, and then have a Q&A panel afterwards, and then another three, and then a Q&A panel after. It'll be action-packed, and it'll be a full-day event. There's more information, and I'll be able to send over those details to you. In fact, I will just pull up the link. We're going to be sending out the email to everybody tomorrow, so you can register, but you can also click here. So you guys are getting first access because we literally just finalize all the information for the email and for the sign up. There is early bird pricing, by the way, so it's a little bit cheaper if you do buy your ticket before the end of January. So just a heads up on that. And I know many of you have come out to these events before. They're great. We really like to dive into it. And one of the cool things is we're going to be diving into a really, really specific 10-year game plan. So what I went through today was literally just a really high-level tip of the iceberg for the 10-year game plan that we'll be going through at that. We'll be doing a workshop over lunch. So yeah, check out the event. It's going to be a really, really good fun day. And if you want to learn more about investing, the opportunities investing in different types of assets, then you'll really enjoy that. If you have any questions, feel free to book a consultation with us. Visit our website and reach out. You can also email us, and we'll be happy to help you. Any of those that don't have my book, Rockstar Real Estate Investing, is a great book on the fundamentals of investing in real estate. So whether you're a first-time investor, first-time buyer even, but you just wanting to understand the nuances and the basics of investing in real estate, great book for you to read. Happy to send a copy over to you. And of course, you can contact us by emailing us, calling us, or following us on Instagram or Facebook. So I think I've answered so far the questions in the chat and in the Q&A. I'm going to open up for questions now. So any questions from you guys? I know you guys are usually pretty good about asking questions. So I'll open up to you guys to ask away. I'm going to grab some water while I wait because I've been talking nonstop for 40 minutes. Oh, great question, Gurpreet. Okay. Fixed or variable? That question comes up a lot. Interestingly, for the last 2 or 3 months, it's a dead heat. The 3-year fixed, the 5-year fixed, or the variable are all exactly the same. When I say exactly the same, I'm talking like a marginal difference over the next 5 years. So it looks like with the current expectations, if you took a variable, then you're going to start at a lower rate, and then over time it's going to tick up ever so slightly. And then if you look at the interest cost of that versus the 3-year fixed versus the 5-year fixed, they're almost all exactly the same. And every couple of weeks, one of them shifts a little bit, and then the other shifts a little bit there. Like as of right now, I wouldn't be surprised if maybe the 5 years showing just a little bit better. I have been noticing, so 5-year fixed rate money is more expensive than 3-year rates, and then variables are lower. But if the trend is that rates are going to slowly go up, I've been finding that for the first time in quite some time, more clients are opting for the 5-year fixed again. It's been a while since people have wanted the 5-year fixed. I would say that probably from September of 2023 until very early 2025, a lot of our clients, especially investors, were comfortable going variable. And that was what the pendulum was showing, is that variable would outperform fixed rates at that time, especially because fixed rates in late 2023 were very high. They were up in the 6s. So it made sense for people to go variable at that time. But the pendulum is swung because of our good friend down south, and all the tariff situation is very inflationary. And so all of a sudden, that pendulum swung. And since early this year, or I should say early 2025, all of a sudden fixed became more favorable than variable, and then it's kind of hanging in the middle. So hard to say. What this comes down to is this kind of a personal opinion. But a lot of people are just thinking, you know what, I just don't want to take the risk. A lot of people are taking the 5-year fixed. And if it's a investment property or property that you might sell early, the only concern then is the 5-year fixed rate penalties can often be more expensive than a 3-year fixed or variable. And so that's often a nudging point to go 3-year fixed or variable. So if you own investment properties and you're okay with fluctuations in the interest rates, then variable is still a strong choice for an investor, especially because you can unlock it at any time. I'm not so sure about a first-time home buyer getting a variable with the fluctuations. I don't know if that's the right move. Adele's asking, is the event available by Zoom or just in person? It'll be just in person. We might record bits and pieces of it, but I have a feeling that that we probably won't be able to record the entire event. So it'll be an in-person event, Adele. Igor is asking, when is the Anthem event coming up? It's coming up this Saturday. I think they just told me today that there's going to be about 500 people there. I'll be speaking at about 1:30, I think it is, on that day, for about 30 minutes or 40 minutes. And I'll go over a couple of things that I went over today, but some other different information as well, and diving into like a rent versus own analysis and a cash flow analysis. So I'll be using live examples, walking people through how I do an analysis on a should you rent or own a property, and also should you buy this investment property. So it's kind of cool. Irene is asking, is 3.82 3-year fixed a good rate, or 5-year variable 3.75? At that rate, I would say 3.82 3-year fixed probably would be better than the variable at 3.75, because the 3-year fixed rate is going to be there for 3 years, whereas even just one prime rate increase to the 3.75 variable puts you at 4, which is considerably higher. So unless you think you might sell the property short term, I'd probably go with the 3-year fixed. Let's see here. I've got another question. If I have significant amount of equity in my primary residence and a cabin short-term rental, debt servicing is maxed or nearly maxed, but would like to access more equity, what's the best route to access equity? Maybe a deeper dive. It would be a deeper dive for sure. What I usually find is if you have a lot of equity available in your home, there might be programs like a net worth program, or some lenders allow you to have a higher debt servicing amount in certain circumstances. So as of right now, we have a client that is one of those pre-sale situations I was mentioning earlier, where they said, oh, my bank's telling me no. And we just underwrote and reviewed the file today. It looks like if the borrower puts 35% down, we can get it approved, because this particular lender, they premium the rate a little bit, but instead of the debt servicing ratio being 44% to maybe about 48% on exception, they'll go up to 70% debt servicing exception. So they're a lender that allows you to get a much higher number. They'll give you a mortgage, and they have a line of credit product, which is really nice and flexible. It's a good lender. So there are different options. If you have liquid assets within a net worth program, could be a good fit. And also there are some other options. If you're borrowing no more than about 65% of the value, then you'll find that there's more options, but it will be more of a deep dive. I think that the best strategy would be to reach out, and Brian can go through some things with you high level over the phone and give you an idea of what might be possible. And then if it makes sense to maybe dive in and start the process, we can get some more information and go from there. The Anthem event is open for you to attend. Yeah, here I'll find the information here, and then I'll post it here. Start with Anthem. So yeah, they're going to have a couple of things. I think they're working on blowing out some units, I think, at this event. And so I know that even when I was talking to them, they were saying, oh, we're going to lower this unit by this price, et cetera, and try to get them moving. I've heard they're going to be giving away a lot of prizes too at the event, so you might even walk away with a nice free prize, which is good. But feel free to come over. Myself and Brian will be there for most of the day, and come and say hi. It'd be great to see many of you. Susan's asking, what is the best 5-year fixed rate right now that you're seeing for an uninsured mortgage? That would be in the low 4s right now. So a lot of the lenders have moved up over the last little bit. I just got one done at 4.09 as of just the other day, but I had to really fight for it. That was a 30-year amortization, by the way. And then I'm seeing some lenders that are around 4.14. Most of them are higher, though. Most are 4.24 or higher for 5-year fixed. So depends on the lender. I do have one international bank that is giving us, I think you can get as low as 4.04. So there is one bank that's still pretty low in the low 4s. But yeah, every situation is different. We'd have to take a look at qualifications and all that. Hey, Cheryl, good to see you. Awesome. Any other questions from anybody? Another question. So I have a mortgage with CIBC. Can I extend the remaining amortization to 30 years? I have 14 years, 9 months left, and that we did lower the payment. Yeah. So what I find is on a mortgage renewal, where you don't have to requalify, you don't have to do anything, they usually do not want to re-extend the amortization. I have found sometimes if you've been opting to make extra payments on your own accord, so you made lump sums, etc., then they can sometimes reduce the payments to what the original amortization minus time elapsed is. So if your amortization is 14 years, 9 months left, but you started on a 30 year 5 years ago, and you've just been really hammering down and making extra payments, and sometimes they can extend it back to 25 years, which would be the time, amortization you started at 30 minus the 5 years you've been into it. However, most of the time people haven't been doing that. And in order to do this, you typically need to requalify. So it starts to open up the door to going through a full application. In those cases, you could go through CIBC to do that, but you can also contact us. Now, I have found on every once in a while, especially if you plea and play the I can't afford the payments card and I might not make my payment on time, that kind of thing, they might extend the amortization for you, but it's pretty rare. So you could always start there because it would result in you not needing to do a mortgage. But otherwise, usually need to requalify and refinance. Yeah. Okay, awesome. I think I've answered everything, and I think we've gone through all the stuff in the chat as well. I think that was it, right? Yeah, good. Okay, guys. Well, what I'll do is, I moved to the screen here. What I'll do is I'll wrap things up now. It was great seeing many of you. Looking forward to seeing you guys at the next event. Remember the February 21st event. Put in your calendars. You will see an email from us tomorrow with more information on that. And then the link I also posted in the chat here. And then for any of you guys that want to go out to the Anthem event and maybe win a free prize on Saturday and come see me and whatnot, then maybe I'll see you on Saturday. Okay? Thanks, everyone. Have a great night. Talk to you soon.